All right, let's go through this. Let's compare two mortgages. Let's compare a 15-year mortgage versus a 30-year mortgage. I've been getting a lot of questions recently about the content we've been putting out. What's the best mortgage to go into? Should I pay my house off? You said paying cash is no better than financing. So what do we do? What are our options? So in today's video, I want to go through why a 15-year mortgage is not necessarily better than a 30-year mortgage. And I want to keep the power and control and security in your hands and keep it away from the banks and the large financial institutions. So let's dig in. Remember to like, comment, share, subscribe, and let's get after this because this is going to be stuff that no one's talking to you about. I promise you, no one is giving you this type of information. So let's start with the little quiz. True or false? A large down payment will save you more money over time than a small down payment. True or false? Okay. True or false? A 15-year mortgage will save you more money over time than a 30-year mortgage.
Bruh.
I know what I was told when I was growing up. Remember, they don't teach this stuff in schools, by the way. There's no class to take on this. You have to learn this stuff over time. You have to be a student of how money really works. And it really does challenge your perception of how money works. Blows people away. True or false? Making extra principal payments into your mortgage saves you money. True or false? The interest rate is the main factor in determining the cost of a mortgage. True or false? You are more secure having your house paid off than financed 100%. You know what? Let's dig into these questions. Let's find out the true answers to this. So first of all, it's very confusing. Which is the best? A 15-year mortgage, balloon payments, bi-weekly payments, adjustable rates. I mean, there's things in here that if you don't know what you're talking about can be very overwhelming. Your house is probably the largest personal investment you will ever make. How you decide to pay for it can create unnecessary wealth transfers and cost you more money over the long term than what you'd expect to know. So here's a principle that we need to first make sure we understand. Everything you know, you think is true. But what if what you thought you knew to be true ended up being false? How fast would you want to change that? And so we need to increase your knowledge base. We need to increase what you know to be true. And so let's dig into this. We have accumulated money, we have lifestyle money, we have transferred money. And transferred money is what we're talking about today, and all of the different components of where you can potentially lose wealth transfer in your lifetime. And we're just gonna focus on the mortgage side of it. We'll do other videos on taxes, qualified plans, protection, college funding. I've already had some discussions on major capital purchases, but let's focus on the mortgage side of the conversation for right now. Wealth transfers can occur no matter how you decide to pay for your house. For example, if you finance your house, you transfer the interest to the lending institution for the privilege of using their money to buy your house. Otherwise, if you pay cash, self-finance, you save the interest, but you lose interest as well because of that opportunity cost. That money that you paid cash for the house no longer can earn interest. So understanding where the wealth transfers can occur in your mortgage can prevent unnecessary losses for you. And the first question to explore is, why have a mortgage? There are many reasons to have a mortgage, there are many reasons to not have a mortgage, but there are 3 reasons to consider having one. 1, you don't have enough money to pay cash for your house. 2, the tax deductions are a real thing that we need to consider. And 3, a potential beneficial spread or an arbitrage, the difference between the cost of borrowing for your mortgage and what you can earn on your investments. And we talk about arbitrage all day long in what we do. So inflation is a major consideration in paying down a mortgage. Consider the following. If your monthly house payment, let me change this to $1,500. If your monthly house payment is $1,500 and we're in a 3% inflation rate, then in today's dollars, your future monthly payments will feel like they're going down because the purchasing power of the dollar gets less and less and less. But the flip side of that is true. If your current equity position in your house is, let's say, $50,000, that too is going down. The value of it is going down in today's dollars. So inflation is a huge component of what you need to think about. The bank is also watching its equity grow just as you are. Unfortunately, you're not only pay the bank interest, but also have to pay the principal, giving away the opportunity cost to invest that money and benefit from its future growth. So what is opportunity cost? Opportunity cost is, do you earn interest on your down payment? Is the down payment money accessible? No to either of those. What would your down payment be worth today had you been able to invest it? That's the opportunity cost. So for example, if your down payment was $20,000 and you're able to earn 6% on your money over 5 years, that opportunity cost would be nearly $7,000. Over 10 years, that opportunity cost goes to $16,000. Over 15 years, that opportunity cost goes to $29,000. That means your principal plus the investment of $29,000, that's what you would have missed out on, a $49,000 value during that period of time. What about your house being a good place to park money? Is it a good place to park money? It's a safe place, right? Well, let's talk about this. Hypothetically, let's say the current market value of your house is $150,000, but you bought it for $100,000. And over the time that you've lived there for the last 15 years, you put in $25,000 worth of improvements. Well, that equates to a 1.2% rate of return. Is that a good place for your money? Only you can answer that question. I would argue it differently. Remember, appreciation is independent from equity. So if we use the same thing, $150,000 market value, $100,000 loan balance, $50,000 of equity, the equity in your house is $50,000. In 30 years, the purchasing power of that equity will be only worth $20,000 due to inflation. But by contrast, in 30 years, the appreciated value of your house will be $364,000. And notice that changing the outstanding debt, if I change this from $100,000 to $130,000, changing the outstanding debt doesn't do anything to the appreciated value or the projected value. I'll make it lower. I'll make it $70,000. Does nothing to your appreciation, right? So appreciation is independent from equity. Is your house a good place, right? 1.2%. I don't think so. And let's compare the cost of financing to investment opportunities. So let's just say you have $100,000, or let's do it differently. Let's say you had $600 a month for 30 years, or $100,000 today to let it sit for 30 years. At 6%, $600 a month for 30 years equals $602,000 of a future value, or $100,000 deposited today at 6% in 30 years will be worth $602,000, okay? A mortgage for $100,000, a loan rate of 6%, not taking into account interest and taxes in this, but during that period of time, the principal and interest payments would have been worth $215,000. So $600 a month for 30 years is $215,000 of principal and interest payments. The opportunity cost of that is $602,000 though. So it would have cost you $387,000 of transfer cost, transfer expense by paying for this mortgage this way. Why choose a 15-year mortgage over a 30-year mortgage? The number one reason to pick a 15-year mortgage, or at least this is what you're told, is the interest you're going to save on 15 years is so much better than a 30-year. The perception is a shorter loan duration will reduce the cost of the loan. And if you follow that logic, why not just pay cash? Have no interest payments and think about the interest you'll save if you paid cash using this logic. I don't agree with it, but that's the logic that you're using. So let's do this. Once I get my house paid for, have you heard this one too? Once I get my house paid for, I'll really be able to save. I'm going to take what my mortgage payment was and I'm going to start to save that. So for example, if you have a 15-year mortgage and your mortgage payment is $840 a month, not counting taxes and insurance, at the end of the 15th year, you immediately turn that into an investment of $844 a month. You earn 6% on that money for another 15 years. So that's worth $245,000 at the end of 30 years. First 15 years, you paid your house off. The next 15 years, you took it, invested it at 6%. You made $245,000. As opposed to the difference between a 15-year and a 30-year mortgage is $244. If you took $244 today for the next 30 years at 6%, it equals $245,000. There's no difference. So once you get your house paid off, you'll really be able to say it is a fallacy, right? Okay, let's keep going. Let's compare two mortgages. Let's compare a 30-year mortgage versus a 15-year mortgage, right? So the 30-year mortgage at 6% is $599. The 15-year mortgage, which we already talked about, is $843. So what happens if we compare that? What rate of return is required to pay off the 30-year mortgage in 15 years? So let's take the 30-year, but then if we're going to earn money on a side fund, how much do we have to earn to pay that mortgage off in the 15th year? And the answer is 4.2% net of tax. So after 15 years, the side fund will have grown enough to where it will be able to pay off the mortgage in 15 years, even though we took a 30-year. Now, why would we consider doing that? Well, oh, and by the way, this is, if we earn 6% on the money and not 4.2, we can pay the mortgage off in 14 years, not 15 years. All right. But why would we do this? Well, think about the tax deductions or the taxes. In the tax savings for the 30-year mortgage, even though we're going to pay it off in 15 years, you get $23,000 worth of tax savings compared to a 15-year mortgage. You only get $15,000 of tax savings. So that is tremendous right there. So let's have this quiz again. True or false? A large down payment will save you more money over time than a small down payment. False. Next, a 15-year mortgage will save more money over time than a 30-year mortgage. False. Making extra principal payments into the mortgage saves you money. False. The interest rate is the main factor in determining the cost of the mortgage. False. It's the opportunity cost that is the main factor. Lastly, you are more secure having your house paid off than 100% financed. Let's check. There are many reasons to not have a mortgage, granted, but there are 3 emotional reasons to consider one. Number 1, physical disability. If you're physically disabled, you want to have a side fund of money so you can help take care of the things that you need to take care of. 2, if you lose your job. If you lose your job and your house is paid off, you think you can go back to the bank and ask for a refinance with no income, no job, no stable paycheck? You think they'll let you refinance your house with your money? Don't think so. And 2, the uncertainty of the world. With everything else going on right now, do you really want to put all of your liquidity, use, and control in an institution's hand where you have to ask them permission to pull money out? Or do you want to keep it in a location where you have access, you have use, you have control of the money, right? So here's what we really want to look at right here. What are the benefits? Let's compare the characteristics, and I'll leave you with this. Remember to like, comment, share, subscribe. But do you want all of these benefits over here on the left for your money that you would have used to pay for your house? Or do you want 1, 2, 3, 4, 5? Think about what you want. You are in control of your money. Like, comment, share, subscribe. I'll see you in the next video.